The global economy is in a constant state of flux. Like a complex machine, it relies on a delicate balance of numerous factors. Two of the most critical elements are inflation and interest rates. Understanding these forces is crucial for investors seeking to navigate the global markets successfully. In this essay, we will delve into the dynamics of inflation and interest rates, exploring their impact on various asset classes, and providing actionable insights for investors. Inflation is a general increase in the prices of goods and services over time. It's a phenomenon that affects everyone, from consumers to businesses and even governments. It erodes the purchasing power of money, making each dollar less valuable than it was before. This means that a dollar today buys less than it did in the past, affecting everyday expenses like groceries, gas, and housing. Inflation can be caused by a variety of factors, including increased demand for goods and services, supply chain disruptions that limit the availability of products, and government policies that influence economic conditions. For investors, inflation is a significant concern because it can diminish the real value of their returns. It can eat away at the returns on investments, especially those with fixed interest rates, such as bonds, which are particularly vulnerable. When inflation is high, investors demand higher returns to compensate for the loss of purchasing power, making it harder to find profitable investments. This can lead to lower bond prices and higher yields, creating a challenging environment for fixed-income investors. Interest rates are the cost of borrowing money. They play a crucial role in the economy by influencing the flow of money and credit. They are set by central banks, such as the Federal Reserve in the United States, which adjust these rates based on economic conditions. Interest rates influence borrowing costs for individuals, businesses, and governments. When rates are low, borrowing is cheaper, encouraging spending and investment. Interest rates are a key tool for central banks to manage economic growth and inflation. By raising or lowering rates, they can either cool down an overheating economy or stimulate a sluggish one. Changes in interest rates can have a significant impact on various asset classes, including stocks, bonds, and real estate. When interest rates rise, borrowing becomes more expensive, which can slow down economic growth. Higher rates can lead to increased costs for mortgages, car loans, and business financing. This can lead to lower stock prices as companies face higher borrowing costs and reduced consumer spending. Consumers may cut back on spending, affecting retail and other sectors. Conversely, when interest rates fall, borrowing becomes cheaper, which can stimulate economic growth and lead to higher stock prices. Lower rates can boost consumer confidence and spending, benefiting the overall economy. The global economy is interconnected, and changes in one part of the world can have ripple effects elsewhere. This interconnectedness means that events such as political instability, natural disasters, or economic policies in one country can influence markets globally. Investors must be vigilant and adaptive to these changes. Investors need to be aware of macroeconomic trends and how they can impact different asset classes. Understanding these trends helps in predicting market movements and making strategic decisions. For instance, a surge in commodity prices might benefit energy stocks but hurt manufacturing sectors. For example, if the US Federal Reserve raises interest rates, it can lead to a stronger US dollar, which affects global trade dynamics. A stronger dollar can attract foreign investments but also make US exports more expensive. This can hurt the earnings of multinational companies that rely on exporting goods. Companies may need to adjust their strategies to remain competitive in the global market. Investors should also pay attention to key economic indicators, such as inflation data, which can signal changes in purchasing power and cost of living. High inflation can erode investment returns if not managed properly. Employment reports provide insights into the health of the economy and consumer spending power. Central bank announcements can indicate future monetary policies that might affect interest rates and liquidity. By staying informed and understanding the interplay between inflation, interest rates, and global markets, investors can make more informed investment decisions. This knowledge helps in building a resilient and diversified portfolio. Investors who keep abreast of global economic trends and indicators are better equipped to navigate the complexities of the market, ultimately leading to more strategic and profitable investments.